Hey everyone, and welcome. So, in this explainer, we're going to tackle something that, let's be honest, can sometimes feel like you're drowning in a sea of acronyms. We're going to demystify global sustainability reporting frameworks. You know, the rules standardizing exactly how companies report their environmental and social impacts. If you've ever tried to read a corporate sustainability report and just felt totally lost, you are absolutely not alone. Today, we're going to break it all down step by step. We'll look at exactly how these global standards are structured, and we're going to use the massive, rapidly growing solar energy sector as our guide. But before we get into the weeds, we have to start with a massive question, one that investors, regulators, and even everyday consumers are asking right now. How do investors actually measure the real-world sustainability of the solar industry? Because for years, we've kind of been living in this wild west of ESG reporting, right? Environmental, social, and governance. Companies could basically just cherry-pick whatever metrics made them look good. It led to a ton of messy data and, frankly, a lot of greenwashing. But that era, it's over. The financial world finally realized they needed a standardized, rigorous way to compare one solar company against another, treating sustainability data with the exact same gravity as a balance sheet. Okay, let's dive into this and see how they're actually pulling it off. To really understand the solution, we've got to start at the very top of the pyramid. Back in August 2022, a major shakeup happened in the corporate reporting world. The International Sustainability Standards Board, or ISSB, which is part of the incredibly powerful IFRS Foundation, officially took over the SASB standards. Now, why does this matter? Well, the IFRS Foundation is the exact same body that governs traditional financial accounting standards in over 140 jurisdictions. So by bringing SASB under their umbrella, the ISSB sent a massive signal. Sustainability reporting isn't some niche side project anymore. It is now a core, fundamental part of global financial disclosures. They took an already respected framework and essentially gave it the teeth to become a true global baseline. Now, for these global standards to actually work in the real world, they can't just be one size fits all. I mean, think about it. A software company doesn't have the same environmental footprint as a copper mine, right? And that brings us to SICS, the Sustainable Industry Classification System. It helps to think of this like a giant set of Russian nesting dolls. So the IFRS Foundation houses the ISSB manages the SASB standards, and sitting right inside SASB is the SICS framework, which categorizes the entire global economy into 77 highly specific industries. It groups companies based on their shared sustainability risks and opportunities. Ultimately, it guarantees that investors are always comparing apples to apples. Let's map out exactly how this builds. It's basically a funnel, taking us from the broadest global rules right down to the nitty-gritty operational level. We start at the very top with the IFRS Foundation and the ISSB setting the global agenda. From there, we move down into the SASB standards, which give us the specific methodologies. Then, we filter all of that through the SICS classification system to organize the economy. And finally, boom, we hit the bottom, the specific sector and industry code. This exact hierarchy is how an investor sitting in a Paris office knows precisely what data to demand from a solar project developer in Nevada. So let's zoom in on our specific case study for today. When we open up the SICS framework and look for solar, the very first broad sector classification we land in is Renewable Resources and Alternative Energy. And I think it's really important to pause here and note something. Just because a company is in a green sector doesn't mean they don't have an environmental footprint. Building green infrastructure literally requires massive amounts of raw materials, land, and energy. This broad sector category groups together all the industries trying to replace fossil fuels, setting the perfect stage for the strict industry-specific standards sitting right beneath it. And here is where we hit our specific industry code, RR-S, which stands for Solar Technology and Project Developers. This is the exact classification we're decoding today, and it is a surprisingly broad umbrella. It covers the entities manufacturing the actual solar PV modules, the companies producing the raw polysilicon feedstock, and the developers building or financing large-scale solar farms. Whether a company is dealing with traditional crystalline silicon or newer thin-film technologies like cadmium telluride, if solar is their main game, RR-S is their new reporting Bible. What's absolutely fascinating here is what these companies are now forced to disclose. We are way past the days of vague corporate statements about protecting Mother Earth. The actual source material for this standard mandates hard operational data. We're talking specific measurement topics, strict categories like quantitative data versus management discussion, and very specific units of measure. Think gigajoules for energy or thousands of cubic meters for water. This entirely removes the guesswork. If a company claims they're managing their environmental footprint, they literally have to prove it with standardized math. So what exactly does the RST code track? Well, the key measurement topics are incredibly targeted. First up is energy management in manufacturing. Making solar panels actually requires a massive amount of grid electricity, so tracking how much renewable energy a company uses to make its renewable energy products is a huge deal. Second is water management. Ultra-pure water is required to produce panels, so the standard demands hard data on water consumed in regions dealing with high or extremely high water stress. Then, of course, hazardous waste management. Next, ecological impacts, which is super interesting. It literally tracks the number of days a project gets delayed due to environmental permitting or endangered species issues. And lastly, product end-of-life management. Basically, what happens when all these panels finally retire? You can really see how the standard demands a 360-degree view of a company, beautifully balancing both quantitative and qualitative data. For example, with hazardous waste, a company has to report the exact metric tons they generate and recycle. That's a huge deal for thin-film solar tech using materials like cadmium or gallium arsenide. For the panels themselves, they have to report the exact percentage that's actually recyclable. But numbers aren't everything. For things like critical materials, the standard shifts gears and requires a rigorous qualitative discussion. Companies have to explain how they manage supply chain risks, physical shortages, and the environmental red flags hidden deep in their polysilicon supply chains. Now, let's talk about how companies actually apply this in the real world, because business is rarely simple. If you're a pure-play solar manufacturer, meaning solar is literally all you do, it's easy. Your primary industry is RST, and you basically just consult this one SASB standard. But what if you're a massive diversified conglomerate? Say you make solar panels, but you also run wind farms, operate natural gas pipelines, and build grid infrastructure. Well, the guidelines are clear. Companies with substantial business across multiple sectors have to cross-reference and blend multiple SISC's industry standards. It's the only way to accurately capture all the complex sustainability risks that could impact their cash flows. So all of this sounds great, but when does it actually happen? The crucial point here is the timeline. The version of the standard we've been unpacking today, version 2023-12, is officially effective for all annual reporting periods beginning on or after January 1st, 2025. Sure, early adoption is encouraged, but 2025 is the hard line in the sand. That means solar companies and developers all over the world are scrambling right now. They're overhauling their internal data tracking systems to ensure they can meet these intense, globally aligned ISSB requirements. The days of sustainability reporting being an optional PR exercise, those are officially over. Which leaves us with a pretty provocative thought to wrap up on. As the RRSD standard and this entire SICS framework become the mandatory global norm, how will these hyper-detailed disclosures reshape the future cost of capital in the energy sector? Think about it. If a developer is constantly delayed by ecological mismanagement or sourcing from incredibly risky supply chains, that data will now be fully exposed for every investor to see. Will we see capital flee from the inefficient operators and just flood toward the companies that have mastered both clean technology and clean operations? It is going to be a fascinating shift in the financial landscape for sure. Thanks so much for joining me for this explainer, and as always, keep questioning the data behind the headlines. See you next time.